Hey everyone, welcome back to Corporate Dakota, the place where we try to figure out what these giant corporate reports actually mean for the companies themselves and for us investors. Today we are dissecting MSC Industrial Direct Co. Incorporated's latest quarterly report, and let me tell you there are some interesting shifts happening within their operations. This is essentially a financial snapshot for the period ending the 29th of November 2025. Think of it like a checkup for the company to see how it is doing in those crucial 3 months. We want to see if they are making more money, are they spending wisely, and what are the big picture trends. Now, MSC is a big player in North America. They distribute industrial products and they focus on helping their customers be more productive. They offer a massive range of products, something like 2.5 million different items. They do this through their website, their catalogs, and by having a strong sales force. They also use technology like vending machines and plant programs to keep critical supplies readily available for their customers. Let's dive into what is actually happening financially. For the 13 weeks ending the 29th of November 2025, MSC generated $29.4 million from their operations. Now that is a decent chunk of change, but it is actually a drop from $101.9 million in the same period last year. This is a significant decrease, and it tells us something is shifting in how they are managing their cash. They also spent more on dividends and bought back stock, which is fairly standard for a company like this, but the drop in operational cash flow is definitely worth noting. Looking at their sales, it is a bit of a mixed bag. Net sales did go up by 4.0% to $965.7 million compared to the previous year. This increase was driven mostly by pricing with a bit of help from foreign exchange, but the actual volume of sales, the amount of stuff they sold, went down slightly. This suggests they are raising prices to offset lower demand for certain items. They break down their sales by customer type, and this is where things get a little more nuanced. Manufacturing customers saw a 5.4% increase in average daily sales, while non-manufacturing customers had a smaller 1.3% rise. However, public sector customers actually saw a 5.2% decrease in average daily sales. This is likely due to that federal government shutdown that was going on. It shows how different parts of their business can be affected by external events. Gross profit, which is basically what is left after they pay for the goods they sell, also went up by about 3.8%. Importantly, their gross profit margin stayed flat at 40.7%. This is a good sign because it means they are maintaining their profitability on each sale even while dealing with changing economic conditions. They are not sacrificing their margins to make sales. Now let's look at operating expenses. These are the costs of running the business like salaries, rent, and marketing. They increased by 2.6% to $311.6 million. However, as a percentage of net sales, they actually went down slightly to 32.3% from 32.7%. This is positive news because it shows they are controlling costs relative to their sales growth. Freight expenses decreased, which is good due to better network efficiency and depreciation, and amortization costs went up, mainly because of investments in their e-commerce and digital initiatives. Advertising, however, saw a significant jump. The company spent more on marketing to boost their efforts. The company incurred $4.9 million in restructuring and other costs. This is more than double from the previous year. This is primarily due to severance and separation benefits as they reduce headcount and optimize their sales force. They also incurred consulting fees to improve their operations and supply chain. It seems like they are actively trying to make their business leaner and more efficient. So with all of that income from operations, or the profit they make from their core business activities, increased by 5.5% to $76.2 million. Crucially, their operating margin improved slightly to 7.9% from 7.8%. This is a direct result of their operating expenses growing slower than their net sales. Other expenses, which include things like interest payments and fees, decreased significantly by 25.3%. This is largely because of lower interest costs on their borrowing and reduced fees related to their receivables purchase agreement. It means less money is being spent on financing and administrative activities. Putting it all together, net income attributable to MSC Industrial increased by 11.1% to $51.8 million. This is a solid gain and shows that despite some headwinds, the company is managing its finances well. Now let's talk about liquidity and capital resources. As of the 29th of November 2025, MSC had about $40.3 million in cash and cash equivalents. This is lower than the $56.2 million they had at the end of the previous fiscal year, but it is still a healthy amount. Their total debt increased by about $45 million to $531 million. This increase is mainly from high net borrowings on their credit facilities. The company believes they have enough cash and resources to meet their needs for at least the next 12 months. Here is an important point. Their net cash provided by operating activities was $29.4 million for the first quarter of fiscal year 2026. That is a big drop from $101.9 million in the same period last year. The report attributes this to a rise in prepaid expenses and inventories and a decrease in accounts payable and accrued liabilities. They also point to a larger incentive compensation payment made this year. While overall net income is up, the actual cash generated from daily operations is down significantly. This highlights the importance of looking beyond just net income. Their working capital, which is current assets minus current liabilities, actually increased compared to the previous fiscal year end. This is mainly due to higher inventory levels and prepaid expenses. Their current ratio, a measure of their ability to pay short-term debts, has slightly decreased. Days sales outstanding has increased, meaning it is taking them a bit longer to collect payments from their customers. This is something to keep an eye on. Inventory turnover has improved though, which is a good sign of efficient inventory management. Cash used in investing activities remained fairly stable at around $21 million for both periods. This money is going into property, plant, and equipment primarily for their vending programs and technology investments. They are continuing to invest in the future of their business. Financing activities saw a significant change. They used less cash this period compared to last year, but this is mainly because they borrowed more money. They spent less on repurchasing their own stock and paid out slightly more in dividends. They also acquired the remaining interest of WMF Hearst Co. Incorporated for about $8.2 million to gain full ownership. MSC operates in a single reportable segment, which is pretty common for this type of distributor. They measure their performance by looking at their consolidated operating margin and net income. Their net sales remain strong with a slight increase in operating margin. The company is clearly focused on optimizing its operations and profitability. They've been making strategic changes to their workforce and supply chain, which has led to increased restructuring costs. While these costs are high in the short term, they appear to be part of a larger strategy to improve efficiency and reduce operating expenses as a percentage of sales in the long run. So what is my take on this report? MSC Industrial Direct seems to be navigating a complex economic environment pretty effectively. Their sales are growing and their gross profit margins are stable, which is a testament to their market position and pricing power. The increase in restructuring costs is a concern in the short term, but it aligns with a strategy to improve efficiency. The significant drop in cash from operations is something to watch closely. However, it could be a temporary effect from timing of payments, or it could signal a tightening of cash flow, so investors will want to monitor this closely. They are investing in technology and e-commerce, which is crucial for staying competitive. The public sector sales dip due to government shutdowns is understandable and likely temporary. Their overall direction seems to be towards greater efficiency and a stronger digital presence, which are positive signs for the future. Alright, that is our breakdown of MSC Industrial Direct Co. Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord community linked in the description for ongoing discussions. Thanks for watching. See you next time.